Yeah, so this week is quite interesting because it seems to be dawning upon the punditry in Australia that we're going to be following the rest of the world towards the zero interest rates regime that's been going on around the world for the last 10 years or so. And it's kind of like shock horror that we're going in down this path. And it's quite an interesting story because I wonder what possesses the people in control of Australia's Reserve Bank to think that a policy that has been in place around the world for the last 10 years, which is clearly failing, somehow is going to work when applied here. Because ever since the GFC, we've been fed this story that we need lower interest rates in order to stimulate the economy. That's what they call it. That's the term they use. It's stimulus. Are lower interest rates stimulating the economy, or are they in fact doing the exact opposite and depressing the economy? And it's quite interesting that there is no argument being put contrary to the conventional one that lower interest rates are good and that lower interest rates equal stimulus. The reason why I bring this up is I think that there are two really big consequences of lower interest rates which are really hiding in plain sight, which no one seems to be talking about. The first one is that clearly lower interest rates mean that borrowers are going to have to pay less for the money that they borrow. But the flip side is that anyone with money or any savings or any capital is earning less. So the question becomes one of, if you're going to stimulate one section of the economy by lowering rates, by encouraging people to borrow more money, you are also going to be depressing another area of the economy by paying less money to depositors and to people who have got savings. So those people will be spending less. It seems to me that the jury is still out as to whether the stimulus part is winning versus the depressing part. It is not clear that lowering rates is causing people to spend more money. It may be causing people to spend less.
It's raising asset prices.
That's a whole different story. And the raising of asset prices is inevitable if you lower rates. However, the raising of the asset prices is only stimulatory in the sense that it makes people feel wealthier, so they borrow more money. That's the idea. They spend more money, but they spend more money by borrowing because their asset prices are going up, so they feel wealthier, so they borrow more and spend more. Because if you spend your assets, you don't have your assets anymore. So they are borrowing against their assets in order to spend money, and they feel okay carrying that extra debt because their assets have gone up in value. That's what the lower interest rate argument does there. But that really is trickle-down economics. What they're saying is wealthy people feel wealthier, so they spend more, and that trickles down onto the rest of us. That is plain and simple trickle-down economics. Now the thing is, the jury's also out on that one. Does trickle-down economics work? Because what we've seen over the last 20, 30 years in the world, ever since the Reagan-Thatcher kind of revolution and freeing up of financial markets and the invention of trickle-down economics as an excuse for giving money to the rich, the problem is the gap between the rich and poor hasn't been improving over these last 20 or 30 years. It's been getting worse. And if it hasn't been improving, maybe it's because trickle-down economics doesn't actually trickle down. Maybe that's the reason why there's a bigger gap between rich and poor, because giving all that money to the rich people is not trickling down to the poorer people. It is not redistributing wealth the way they claim it is, and the whole thing's a ruse. And that's another reason why everything is stagnating. The final point that I want to make with regards to the lowering of rates and how it stimulates the economy, first of all, the Reserve Bank, they lower rates. Then they start talking about how, they're just cautioning people to be careful because lowering rates may cause house prices to go up again. I beg your pardon? Lowering rates may cause house prices to go again. That's why you're lowering rates, guys. You're lowering rates because you want house prices to go up. And you're sitting there behaving like you're surprised that lowering rates might cause them to go up again. That's problem number one. Problem number two is, when you lower interest rates, what you're doing is you are making it easier for excess capacity to develop in an economy. Okay? And the way I'd like to describe this is, lowering rates lowers the cost of capital. Lowering the cost of capital means that it's easier to stay alive when you shouldn't be staying alive, in a capitalist sense. Lowering rates means that the cost of being a zombie is lowered. So if you're a company that's not really making a profit, if you're a company that's not really efficient, if you're a company that actually shouldn't be there anymore because of creative destruction as far as capitalism is concerned, lowering rates enables companies that should not exist anymore to continue existing. What that really means is that the normal business cycle of a lot of demand for something, leading to a lot of production, leading to more factories, leading to more services, leading to more of things because there's more demand, right? Normally causes an excess capacity. In other words, there are too many buses, there are too many taxis, there are too many factories, there are too many houses. And what that causes is it causes the price of those things to come down because there are more of those things than the economy needs. When the price of those things starts coming down, a lot of producers of those things go out of business because their business can't survive at those prices. So what happens is, a lot of things get creatively destroyed as a result of that, and that causes scarcity, which then causes the price of those things to stop going down, to start coming back up again, which then causes more production of those things, which then causes more opening of factories and more taxis and more. That's a kind of a cycle. What's happening with us now is, when the price of things start going down because there's too much capacity, the Reserve Bank steps in and makes the cost of capital cheaper so that all of those zombies that should be falling off the wagon don't fall off the wagon. Which means that all of that excess capacity is kept alive. Which means there's even more pressure on prices to go down because there's too much capacity. There are too many factories. There are too many taxis. There is too much of this stuff. So the market is trying to reprice downwards, but the Reserve Bank, through lower interest rates, is stopping that from happening because the capacity keeps on growing and growing and growing and growing. China keeps on stockpiling more and more and more iron ore at its ports. The price of iron ore keeps on going up even though there is so much at the port, because cheap money enables more warehouses to get built to stock the iron ore, even though it's not economic to do it. That kind of cycle is what's going on. That kind of cycle means that actually, far from stimulating the economy, the low interest rates might perversely be doing the exact opposite. They are actually causing the economy to sag under excess capacity. That's the reason why wages can't go up. That's the reason why there's all this fear about deflation and prices going down. The people who are warning us about all these problems in the world are causing all of the problems in the world. And the price of money just keeps on going down because they don't know what else to do. They just keep on lowering it. They keep on warning us that what they're doing is a really bad thing and that's going to cause all sorts of problems, but they just keep on doing it. Why don't they start increasing interest rates? If there's too much debt, if there's too much capacity, if the economy's really sluggish, because there are no new entrants coming in, there are no new ideas coming in. Why not start slowly fixing the problem by slowly raising interest rates? Raise them slowly when you've got plenty of time to do it, when you can do it in a controlled fashion. You can start weaning people off the debt. You can start weaning the economy off all of this excess capacity. Why didn't they start doing this 10, 15 years ago? Why are we in a situation 10 years now after the GFC, and we are now staring down the barrel of exactly the same problems that we had before the GFC, but just much worse? And interest rates are on the bottom, and the debt is doubled. I don't know what else to say.